It wasn't the nuclear warheads. It wasn't the ideology. It wasn't even the spies. The Cold War map shifted. East Germany, Iran, Chile, Angola, Vietnam, not just because of power or propaganda, but because of balance sheets. Everyone tells you it was capitalism versus communism, but if that were true, why did both sides borrow from the same banks? Behind every missile test and coup, there was a hidden current flowing, not red or blue, but green. Dollars, rubles, gold, oil futures. While politicians delivered speeches, backroom dealers, central banks, and offshore intermediaries moved money, secured resource routes, and flipped governments. Not for freedom or equality, but for credit stability and trade access. Start in 1953. The CIA helps overthrow the Iranian Prime Minister, Mohammad Mossadegh. They say it's to fight communism, but behind the curtain, Mossadegh was nationalizing British oil, cutting out Western revenue. The coup wasn't about red flags. It was about black gold. The British pound was dying. The US dollar needed oil priced in greenbacks. Iran's independence was a threat to both. Jump to Chile, 1973. The military crushes Allende's socialist experiment. Again, we're told it's a war of ideology. But look closer. Allende had moved to nationalize copper, Chile's main export, dominated by U.S. firms like Anaconda and Kennecott. A successful leftist economic model would have sparked copycats across Latin America. More nationalizations, less Wall Street leverage. Even in the Soviet sphere, it wasn't Marx that cracked. It was the math. By the 1980s, the USSR was drowning in debt, hemorrhaging hard currency, and dependent on grain imports paid in dollars. They hadn't lost the arms race. They'd lost the credit race. See, geopolitics is the theater. Finance is the script. The Cold War wasn't just fought in jungles or boardrooms. It was fought in bond markets, secret bank transfers, and IMF memos. And once you follow the money, from Bretton Woods to the Petrodollar, from Eurodollars to the Ruble USD shadow exchanges, the picture changes. It wasn't East versus West. It was creditor versus debtor. And the side that controlled money supply flows, proxy war funding, and energy pricing controlled the map. To understand how the Cold War became a financial chessboard, we have to start before the war even began, in 1944, in a sleepy town called Bretton Woods, New Hampshire. While the Second World War was still raging, 730 delegates from 44 Allied nations gathered at a hotel not to talk about weapons, but about money. Gold, exchange rates, capital flows. The guns hadn't even gone silent, but the bankers were already drawing the next world map with currencies. The U.S. emerged from the war not just as a military superpower, but as the undisputed creditor of the world. Most of Europe was physically destroyed and financially bankrupt. The British Empire was finished, not by battles, but by its balance sheet. London had sold off 2/3 of its overseas assets just to survive. It owed the U.S. billions. So the Americans proposed a new system. The U.S. dollar would become the anchor of global trade, fixed to gold at $35 per ounce. Every other currency would peg itself to the dollar. And behind this arrangement sat a promise that dollars would be as good as gold and America would always redeem them. That system, the Bretton Woods system, was the invisible foundation of Cold War finance. On paper, it looked simple. But in reality, it created a mechanism of power the world had never seen before. Because if all global trade depended on the US dollar, then anyone who needed oil, wheat, machinery, or spare parts needed dollars first. And who issued those dollars? The Federal Reserve. Who controlled their supply? The US Treasury. Who benefited from every foreign central bank holding dollar reserves? Wall Street. This wasn't just economics. It was infrastructure, monetary infrastructure, as decisive as roads or pipelines. But it went deeper. America didn't just offer dollars, it offered development. Through the newly created IMF and World Bank, countries emerging from colonialism were handed what looked like lifelines, loans, advice, modernization plans. But these lifelines came with strings. Nations were told to open their markets, suppress labor movements, keep foreign investors happy. Nationalize your copper mine? risk capital flight. Talk to the Soviets, your loan disappears. And meanwhile, on the other side of the Iron Curtain, the Soviets were building a mirror system, not of global credit, but of barter. They didn't have dollars, so they exchanged oil for wheat, tanks for tractors, rubles for allegiance. The Comecon bloc, the Economic Union of Eastern Countries, was less about ideology, more about trade routes. Hungary got Soviet gas, Bulgaria sold food to East Germany, all tracked by bureaucrats instead of bankers. But here's the twist. By the 1960s, even the USSR needed dollars. Why? Because real trade, ships, wheat, machine parts, was increasingly priced in greenbacks. Third world nations didn't want rubles, they wanted hard currency. And Moscow started doing quiet business with the same Western banks it condemned in public speeches. This was the birth of the dual-track Cold War: public confrontation, private transactions. While Kennedy and Khrushchev glared over Berlin, their trade officials worked through intermediaries in Paris, Zurich, and Vienna. Bankers created eurodollars, offshore dollar accounts in London and Geneva, outside U.S. regulation. These accounts became the lubricant for covert deals, from Soviet grain purchases to CIA-backed war funding. Think about it. The USSR bought Canadian wheat with dollars it earned by selling oil to Italy. Cuba sold sugar to the USSR and paid Czech technicians in rubles. Meanwhile, American companies used Swiss francs to sell machine tools to East Germany. Every side was using finance to play both ends. So from the very beginning, the Cold War wasn't a pure military or ideological conflict. It was a system built on economic dependencies, hidden trades, and a shared addiction to liquidity. The dollar became the global bloodstream. And Washington, through its control of that flow, could decide who lived or collapsed. Need proof? Look at 1947. Britain is starving. Its colonies are gone. It's broke. So the U.S. offers the Marshall Plan, $13 billion, but not just for rebuilding. The fine print? The pound must become convertible again. Britain agrees. Within a month, speculators attack the pound, gold drains out, and Britain goes back to capital controls. It was a lesson in who now controlled the financial empire. The same pattern followed in France, in Greece, in Japan. Reconstruction wasn't just physical, it was monetary reprogramming. And in the background, the Cold War system was built not on treaties or tanks, but on pricing power, interest rates, and access to the dollar spigot. The post-war order wasn't just created, it was engineered, and the Cold War was its operating system. It's not a conspiracy, it's a blueprint. And once you see how they built it, you start to see why it looked so stable for decades, until the numbers stopped adding up. For almost 2 decades, it looked like the system would work forever. From the outside, the Cold War era, especially the 1950s and 60s, seemed like a golden age. Western Europe was rising from the ashes. Japan was becoming an industrial giant. The U.S. was the world's factory, the world's banker, and the world's consumer rolled into one. The dollar, backed by gold, flowed like water. And under the surface, American power was compounding, not just in weapons, but in interest. Remember this: every dollar sent abroad came back as demand for American bonds, American exports, or American influence. Foreign central banks had to hold dollars to trade, and that meant buying U.S. treasuries, IOUs to fund Washington's growing budget and military commitments. It was a beautiful feedback loop, for a while. Dollar out, goods in. Dollar held, U.S. asset bought, more dollars out. And with each cycle, the U.S. bought loyalty. France got reconstruction aid. Germany got NATO security. Japan got market access. Latin America got IMF loans. But all of them, every single one, got dependent on dollars. In this illusion of endless liquidity, even the Soviets played along. They couldn't match the West's consumer boom, but oil revenues surged. When oil prices rose after 1973, Moscow suddenly found itself flush with hard currency. It used that windfall to buy Western food, technology, even Pepsi bottling rights. The same Soviet economy that claimed to be self-reliant had become a dollar customer. But this wasn't real prosperity. It was debt-fueled discipline. because in order to stay in the dollar game, countries had to play by the rules. Keep inflation low, keep your markets open, and, most importantly, don't challenge the pricing system. Take oil. After World War II, nearly all oil was priced in dollars, not by law, but by practice, enforced by U.S. influence over Saudi Arabia and the Gulf monarchies. When a country needed oil, it had to get dollars first. That meant exporting to the U.S., borrowing from U.S.-backed banks, or earning them through aligned trade. Now imagine what happens when a country steps out of line. Egypt nationalized the Suez Canal in 1956. Britain and France responded militarily, but the U.S. shut it down by threatening to sell British bonds and collapse the pound. It wasn't tanks that ended the invasion, it was the fear of a currency run. This is the hidden layer of Cold War politics, the financial veto. If you disobeyed the unspoken rules of the dollar order, Washington didn't need to invade. They could tighten the flow, cut your access to the bond market, let your reserves drain. Suddenly, your economy couldn't import fuel, food, or medicine. Even allies learned this lesson. In 1965, French President Charles de Gaulle began questioning the dollar's role. He demanded gold for France's dollar holdings, triggering panic in Washington. Why? Because there weren't enough gold bars to cover all the dollars circulating globally. The illusion of convertibility was just that, an illusion. Still, the system limped on. Illusions are powerful. By the late 1960s, everyone was participating in what economist Triffin had warned. The U.S. had to run deficits to supply dollars to the world. But running deficits would eventually destroy confidence in the dollar itself. This was the original Cold War contradiction. The U.S. had to overspend to maintain control. Military bases in West Germany, aid to South Vietnam, secret operations in Latin America, loans to Turkey, Greece, Taiwan, billions in financial commitments, all sustained by dollar issuance, not gold production. But no one wanted to rock the boat. As long as the illusion held that the dollar was as good as gold, that trade was free, that growth was natural, the show went on. Even in the Soviet bloc, illusions reigned. Central planning looked stable. 5-year plans kept factories busy. State propaganda said socialism was winning. But behind the posters, hard currency shortages were growing. Eastern Bloc countries borrowed from Western banks to finance consumer goods. Hungary and Poland took IMF advice, quietly. Even the KGB began to monitor foreign debt levels, because they knew real power wasn't ideology, it was balance of payments. And in the Third World, a new illusion emerged, development through debt. Countries like Brazil, Indonesia, and Zaire were told, borrow now, grow later. Dollars flooded in. Highways, airports, steel plants. But all of it was financed with floating rate loans from Western banks. As long as interest rates were low, the illusion held. So from Washington to Moscow, from Lagos to Manila, the Cold War world ran on two things: money it didn't have and confidence it couldn't afford to lose. What happens when the math catches up? We'll get there. But for now, remember this: no system collapses because of bad intentions. It collapses when the numbers outgrow the gold, the real income, or the trust behind them. Illusions are expensive. And by the 1970s, the Cold War illusion, the one built on endless dollars, unshakable credit, and invisible influence, started to crack. The moment of rupture came quietly. August 15, 1971, a Sunday evening. President Richard Nixon appeared on television. Calm voice, American flag behind him, and 7 words that detonated the foundation of the global economy. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold. That temporary suspension? It's still in place. The Bretton Woods promise that every dollar was a claim on gold was dead. Why? Because too many dollars had been printed to finance the Vietnam War, fund Cold War alliances, and prop up consumer spending. There simply wasn't enough gold in Fort Knox to cover it all. The math didn't lie. But instead of resetting the system, Nixon doubled down. He froze wages, imposed price controls, and quietly asked Saudi Arabia to do something that would change the course of history: price all oil in dollars, no matter who's buying. In exchange, the U.S. would guarantee the security of the House of Saud, tanks, jets, military training, a dollar for oil deal enforced by arms. This was the birth of the petrodollar and the Cold War's new invisible weapon. From that moment, every country on earth had to hold dollars, not because of trust, not because of treaties, but because without dollars, you couldn't buy energy. And to get dollars, you had to trade with America or borrow from its banks. Washington had pulled off the financial equivalent of a magic trick. It defaulted on gold and came out even stronger. But that trick had a cost. Interest rates spiked. Inflation roared. Debt burdens exploded, especially in the developing world. Countries like Mexico, Argentina, Brazil, and the Philippines, which had borrowed heavily in the 60s and early 70s, suddenly couldn't pay. Oil prices had quadrupled. Loan payments ballooned. Enter the 1980s debt crisis, not just a Latin American story, but a global financial chain reaction. Mexico defaulted in 1982. Within months, dozens of other countries were on the brink. U.S. and European banks that had overlent were terrified, not because they feared communism, but because they feared insolvency. So the IMF stepped in, armed not with soldiers, but with spreadsheets. Countries were told, privatize, cut subsidies, open your markets, peg your currency, slash public spending. In short, surrender your economic model in exchange for more dollars. The Cold War was no longer about ideology. It was about triage. Debt restructuring became regime restructuring. In Bolivia, Argentina, and elsewhere, economic shock therapy replaced bullets. The new front line was fiscal policy. And it wasn't the Pentagon drawing the lines. It was the Federal Reserve. But the cracks weren't only in the global South. By the late 1980s, the Eastern Bloc was also financially disintegrating. Years of inefficient production, dependence on Western grain, and quiet borrowing had turned the Soviet economic model into a leaking ship. The USSR's oil exports had funded its empire, but oil prices collapsed in 1986. That year, the Soviet Union lost more than $20 billion in hard currency revenues. For an economy that needed dollars to import food and technology, it was a fatal blow. Desperate, the Soviets did the unthinkable. They started negotiating with Western bankers and quietly selling gold reserves to stay afloat. Meanwhile, in Poland, East Germany, and Hungary, protests intensified. Not just because people wanted democracy, but because the economy was imploding. Shelves were empty, foreign debt was piling up, and Moscow could no longer subsidize them. By 1989, the Berlin Wall wasn't just a symbol of oppression, it was a wall of bankruptcy. That same year, Hungary opened its borders. East Germans fled. Czechoslovakia erupted. One by one, the puppet regimes collapsed. Not under NATO bombs, but under budget deficits. The Cold War ended not with a mushroom cloud, but with a spreadsheet. The Soviet Union didn't fall because capitalism won the argument. It fell because it couldn't finance its empire anymore. By 1991, the USSR had defaulted in all but name. The ruble was worthless. Inflation was eating pensions. Military bases were abandoned because soldiers weren't being paid. In August of that year, the empire collapsed under its own fiscal weight. And once again, money had moved faster than ideology. The Cold War didn't end with Reagan's speeches or Gorbachev's reforms. It ended when both sides ran out of accounting tricks. The illusion of infinite liquidity had met the reality of limited trust. The moment when numbers outgrew real assets, when promises, bonds, and balance sheets became impossible to reconcile, that was the real Cold War finale. Arithmetic cannot be deceived, and when it finally caught up, it swept away decades of slogans, alliances, and illusions, all at once. The Cold War ended on paper in 1991, but the money system it created, that never went away. In fact, it expanded. What started as a US versus USSR financial standoff became something bigger, a global hierarchy of money, backed not by gold or ideology, but by trust in debt. And that system, born at Bretton Woods, reshaped by Nixon, tested in the 1980s, is now the air the world breathes. Let's follow the echoes. After the Soviet collapse, the US stood alone, not just militarily, but monetarily. It was the issuer of the world's reserve currency, the lender of last resort, and the final destination for global capital. No empire in history had ever held this much financial power. And what did it do? It monetized everything. In the 1990s, Washington used debt and capital flows the same way it once used Cold War alliances. Eastern Europe was opened up, not through tanks, but through IMF loans, World Bank programs, and promises of EU integration. Russia was told, privatize, dollarize, liberalize. But when Russia defaulted in 1998, the illusion cracked again. Not because of communism, because of derivatives. Western hedge funds, especially long-term capital management, had made huge bets on Russian bonds. When Moscow said, "We're not paying," panic spread through global markets. Wall Street nearly collapsed. The Fed organized a private bailout, and quietly the world realized the dollar system was now too big to fail. Not too big to win, too big to unwind. In the 2000s, the pattern repeated. The U.S. ran massive trade deficits, sending trillions abroad in exchange for cheap goods. But those dollars didn't disappear. China recycled them back into U.S. treasuries. So did Saudi Arabia. So did Japan. Why? Because, as in the Cold War, holding dollars is the price of entry to global trade. But this time, there's no ideological enemy, only monetary gravity. The petrodollar system, still in place. Eurodollars, bigger than ever. U.S. treasuries, still the core collateral of the global financial system. And the enforcement mechanism is no longer just banks, it's sanctions. Look at Iran. Cut off from SWIFT, the dollar-based payment network, its oil buyers punished. Not with bombs, but with bank restrictions. Look at Venezuela. Its foreign reserves frozen, access to dollar markets blocked. Look at Russia in 2022. After the invasion of Ukraine, the West froze over $300 billion of its central bank reserves, something once thought unthinkable. A sovereign nuclear power locked out of its own money. No need for Cold War rhetoric, just a keystroke in a central bank database. And once again, the deeper layer reveals itself. You don't need to occupy territory when you can occupy trade routes. You don't need to win elections when you control the currency pricing system. That's why countries around the world are now trying to escape the dollar's grip. China signs oil contracts in yuan. India settles trade with Russia in rupees. The BRICS nations talk about a new reserve currency. But even as they plan, the underlying infrastructure remains dollar-based. Because trust isn't built in headlines. It's built in settlement. Who gets paid, how quickly, and with what certainty. And here's the modern paradox. The more chaotic the world becomes, wars, pandemics, inflation, the more people run toward dollars. It's the same pattern we saw in the Cold War. Crisis hits, U.S. debt rises, but so does global demand for that debt, just like the 1960s, just like the 1980s, just like now. And yet, the illusion is fraying. U.S. debt is over $33 trillion. Its deficit is permanent. Its manufacturing base hollowed out. The Fed is no longer fighting inflation, it's managing market psychology. And every country holding treasuries is quietly asking, what happens when the trust finally breaks? Because that's the core of it all. The Cold War was a conflict between empires, but the financial Cold War never ended. It just changed uniforms. Today, it's not ideology versus ideology. It's network versus network, dollar versus alternatives, SWIFT versus CBDCs, central banks versus markets. We still live in a Cold War world, not one of missiles, but of monetary architecture. And as always, the real game is invisible. If this pulled back the curtain on today's world order, tell us, do you think the next global shift will be caused by politics or by finance? Because history says the money moves first. Systems don't die when they're defeated. They die when people stop believing in them. The Cold War system, built on gold, then oil, then debt, wasn't destroyed by an army. It collapsed under the weight of its own arithmetic. Empires can lie. Politicians can bluff. Central banks can print. But math doesn't negotiate. The dollar wasn't born eternal. It was engineered, protected, enforced. First through gold, then through oil, then through leverage. And like all empires before it, Roman, British, Soviet, the power lasted only as long as others agreed to play the game. That's the hidden law of money. It's not about metal or paper. It's about trust multiplied by scale. The Cold War taught us that bullets don't win without balance sheets, that alliances mean nothing without access to trade, that behind every revolution, reform, or regime change, there's always a spreadsheet in the background, full of numbers no one wants to read aloud. And that lesson matters more now than ever, because the same mechanisms are still in play. The same petrodollar system, the same offshore finance routes, the same IMF shock treatments, now renamed as restructuring. Only now the stakes are higher and the cracks are bigger. No gold, only promises. No Bretton Woods, only central bank coordination. No Cold War, only cold trust. So if you're hearing this in 2025, know this. The next great shift won't begin with a speech or a protest. It'll begin when the numbers no longer line up, when the debts outgrow the income, when the real economy can't carry the financial one, when a currency no longer buys what it used to, when trust is broken, quietly, then all at once. Because empires fall the same way banks do, not when they run out of weapons, but when they run out of confidence. If you've made it this far, you already see what most never will.